Blame this all on Angie here.
Yep, that's our extension.
Angie sets these things up. I published my most recent book here, and she's like, well, we got to do this big book launch. I'm like, we don't have to do big. Yeah, we got to do a big book launch. So here we are. So I appreciate everybody coming out. I haven't done a lot of these, so we're just going to kind of wing it, but we got a little bit of a presentation. I'm just going to go over a couple areas in the book, but I guess I'm pretty excited about what we put together here. This is now my third book. We have 2 other books, and if you haven't read those, I'm happy to make sure you walk out with one as you leave here today. Some of you may or may not know this, but when my son was born, he's now 14. He's out playing golf with his buddies this afternoon, and big hockey player and wake surfer and all these other fun stuff. But he was born 2 months premature. He was born about 8 weeks early, and he spent 6 weeks in the NICU. So when we got him home, it was basically the week of Thanksgiving. And from that moment on to about 2 years old, him and my wife were never farther than probably about 15 feet. She just was made sure. I mean, in fact, that's what she ended up retiring from her other job at that time, kind of stay at home with my son full time and such. So at 2, she gets a phone call from some gals that she had gone sorority and college with, and they said, come on out to Sioux Falls, let's hang out for the weekend and have some fun. So that's the first time I ever got a chance to visit with my son, just the 2 of us. And she gave me some pretty explicit instructions. She said, anything happens whatsoever, you better be calling me, and you better be calling me 3-4 times a day, checking in and this and that. Well, I'm pretty excited about this event. So I ended up taking off that Friday afternoon, and I picked up my son at noon from daycare. Now, the guys in the room probably don't see anything wrong with that, but I'm going to tell you that noon is nap time in daycare world, and that was the absolute worst time I could have picked him up, probably about 11 o'clock. So I take him out, and at the time we were in Minneapolis, I took him off to Lake Harriet, and we were building blocks, and he was kicking them over. He thought he was having a great old time, and we went and got ice cream and sodas and all this other stuff, and he just became very, very cranky. So about 2 o'clock that afternoon, I figured I better start doing something because he was just not having a whole lot of fun. And I almost called my wife, and then I thought better of it. I said, that's probably not the best idea for me, so I did the second best thing. I called my mom, and I said, what do I do here? I figured that, there were me and 2 other siblings, and we all turned out pretty okay. So figured she'd know what to do, and she said, well, what did you feed him today? I said, I don't know. We had some ice cream, we had some crackers, we had some candy. She goes, so you didn't really get him anything? No, probably not. And she said, well, how about his nap? Did he get a good nap in? I said, no, he didn't get a nap. So she said, what you need to do is get him home, sit down on the sofa, throw in one of those DVDs, one of those movies he likes to watch, and get him to relax. He needs to take a nap. So I went home, I sat on the sofa, I put in a DVD. Everybody's seen the classic by Disney, Beauty and the Beast. Ever seen that movie? Yeah. And I put that thing on, and within 3 or 4 minutes, he was out solid, which was unfortunate for me because I had the movie on loop and I couldn't get up. I was afraid to get him up. He'd be waking up. So I watched the movie twice. But there's an important part of the movie, and that's where all of the villagers get together, and they're trying to figure out what to do with this monster that has moved into the neighborhood, right?
Kill the beast.
That's right. It was kill the beast. They got their tiki torches, they got their their pitchforks, and they're all deciding what to do, and they all come up with this. We have coming out of this pandemic that we just went through, all the stimulus that's been out there, the M2 money supply, we're seeing that filter through with inflation. There's no question that we are going to get in a situation here where taxes have to go up. It's just a matter of borrowed time at this point. And when we think of our retirement accounts, This has all been money we put aside into this account, and we were told never touch this money, right? So you were taking and sacrificing paychecks, putting it into the account. The money is, for many of us, ballooned into a sizable figure that maybe 20 years ago we never thought we'd imagine that we'd have an IRA balance this large. And we have to recognize that these IRAs, that there's every penny of this money that's been put in the account has to be taxed someday. Well, much of my book is about how do we kill the beast? How do we get ahead of this? How do we, what kind of things do we need to be addressing? I believe that we are at 40-year tax lows here. We haven't seen taxes this low in anybody's generation. You know, 1970s, I'm going to go back. Ronald Reagan, during World War II, a lot of families don't know this, people don't know this, but he used to produce 2 movies a year during World War II. Now, this is the #1 actor. I mean, think, you know, Ben Affleck, or I mean, who are the big actors that have been around in our most recent people. He could have worked 50 movies a year, but he never produced more than any 2 movies, because during World War II, the top tax bracket was 94%. That meant that if he had an income, he made $100,000 a movie, and if he had an income over $200,000, he'd get to keep 6 cents of every dollar he made. Well, today, where we're at, many of us are in the 22, maybe 24. Some of you are in the 12. Without any changes at all, Congress, unless they make the current tax law permanent, which I think is very unlikely given the environment, all the stimulus, all the things we're seeing, plus, you know, Washington, D.C. is getting along so well these days. I don't see it changing until the Congress is going to have to, and in a little over 3 years and 6 months, you know, we're going to hit December 31st, 2024. And the current tax code is set to increase everybody's tax brackets from anywhere from 20 to 35% in some cases. And I think we're on borrowed time. And that's a lot of what I talk about in the book. So it's my little disclaimer if you want to read through that. It just says that I'm not a CPA. But I do a lot of tax planning. We've done tax planning here. I've been doing this now for 28 years. Was during the 2000, 2001, 2002 market correction that I realized that financial planning isn't just about wealth accumulation. It's not just about the investments you're making and how to try to get 8, 10, 12% rates of return. It's about how much money do I get to keep and how do I take it back tax efficiently. So that's a lot about what we did here. You know, we talked about the national debt, how it's going to affect our future. Anybody in the room here disagree with me when I say tax rates are going to be going higher? I think the real question is, they're going to go, you know, there's 2 parts of the tax code. There's the tax brackets, right? Which is how much of our dollars are going to get taxed based on different levels. And then there's our personal situational situation, right? If I'm making, you know, $300,000, $400,000, $500,000 a year, and I'm going to be living on $100,000 a year, you may see some reduction in the current tax rates you're paying. But understanding that those tax brackets are only temporary. Every tax code that we have today is only written in pencil, and it can all be easily erased. I think that what we've seen over the last 6 months says that we probably have 3 years and 6 months, but nobody has there could be a lot of interesting things starting even as early as November or whatever, right? So taking advantage of our tax codes and looking at that right now is very important. So in chapter 1, I repeat that story about me and my son. In fact, in the intro, I talk a little bit about Pliny the Elder and Pliny the Younger, which are two Mediterranean folks that were on Mount Vesuvius, and how Pliny the Elder takes off Pliny the Younger takes off with the family to get away from the steam and such coming out of Mount Vesuvius. You know, for weeks they knew Mount Vesuvius was acting kind of funny until it went. You know, that's all pre-BC. Has anybody ever thought about BC? What they used to call 653 BC, back in 653 BC? Do they call it BC? Anyways, that's the stuff that keeps me up at night, I guess. I also talk a little bit, because we're all in the Midwest here, about the difference between a tornado and a hurricane. Right, and being from the Midwest, anybody here from the East Coast? But you've spent some time in Florida, Bill. Anybody else spend some time in the areas with? When I was in the service, I was stationed out of Beaufort, South Carolina. If you remember Hurricane Hugo and all this stuff that was going on in the '80s, I was actually in Japan, worried about my car and all my worldly possessions back at the air station. And Hurricane Hugo came in there. But I remember these other storms would come in. They'd have us out there boarding up everything. You went to the grocery stores because the hurricane was coming, and nothing left but maybe a couple cans of Diet Coke because the water was all gone. And, hurricanes, a lot of times you can see them coming. They start up in the shores of the offside of Africa, and they come all the way around, and then sometimes it's 2-3 weeks. Tornadoes are a little bit different. We might know it's a hot and humid day, and we might have everything right for a tornado, but oftentimes where the tornado hits is fairly quick, very sudden. Good things about tornadoes, though, with the exception of maybe some really big ones down, these F5s and such, they tend to kind of hit a small streak. I look at our tax code today, and to me, it's kind of like this hurricane that's coming up. If we were smart, that we lived in hurricane country, we'd be doing everything we could to start boarding up and stocking up and getting things ready for the pending storm. But I see literally thousands of prospective clients coming through our office every single day that have done actually no prepping at all for a storm that's probably going to be coming. So that's what a lot of the book is about, is how do we make sure that we're addressing what's there, looking at whether I use the analogy of Mount Vesuvius, or I use the hurricane versus tornadoes, or I just simply talk about killing the beast. Hopefully the book is written in such a way that it's easy to follow, in more of a story than a bunch of putting you to bed at night type booking rating. So I'll also talk about the grand illusion. Everybody remember Styx, right? I still like that song a lot, but I've talked over the years, mostly on the radio, about what I used to call the biggest lie in my publisher. So you can't call it a lie. It's got to be called the grand illusion. So we kind of revamped that a little bit to the grand illusion. But if you think back to wherever that was, you were in your 30s or 40s or 20s, or whenever you started setting aside money, everybody kind of had this conversation, whether it was the employer or a family member or a friend or a financial professional. They said, what you need to start doing is start putting money into these accounts, these IRAs, 401ks, 403bs, this tax deferred money, right? And what did they all tell us? You're going to put the money in when tax rates are high. And when you take it out, where our tax rate's going to be? Oh, they didn't tell us that. They told us we would take it out at a lower amount. I know that that's what we were all told, right? We were told about the power of compounding, the power of deferral, and many 10,000 boomers a day are retiring, and we're finding out that most are actually going to be in a situation where they're actually going to be paying higher tax when the money comes out than they ever did before. The other thing, keep in mind, is our IRAs, our 401ks, we lose control of that money. Now, talking about a Secure Act 2.0, which may push off required distributions until 75, come 2033 is what they're talking about, 2036. But the reality is that at 72, where many of you in the room are sitting right now, when you can see that down the road here, we lose control of this. I can't think of another asset we have where we're actually forced to start selling it because of something that the legislature has said, right? We got to start taking this money out, whether the markets are up, the markets are down, the markets are flat. We got to take the money out. We got to take a certain amount. It starts off at 3.65% at 72, hits 4% a couple years later, and 5% by the time you're 80. Most families we visited with have really not looked at what a required distribution is going to mean for them. So they're surprised when we sit down with them at 72 and say, hey, your $1 million account, you got to take out $36,500. And they say, Joe, I don't need that much money. Well, you get to take it out and you got to pay it. And that's because the Congress says. The only other way around it, I'm going to talk about later on here in chapter 8, is about doing some charitable gifting, and not everybody that's as important about doing so. So we talked about the grand illusion. I talked about how the IRS really doesn't care about what your net worth statement says. The IRS only cares about how that money hits the tax return, right? And I think going forward, if they are going to make tax changes around things like this, it'll continue to come back to how do things hit the tax return, the 1040 that gets filed every year, right? We don't get into fancy planning like businesses. When I do my business taxes, I bring it to my CPA and they tell me how I can deduct this or depreciate that. But it's pretty straightforward stuff. How do we maybe reposition things while we have 3 years and 6 months so that we can control what hits the tax return down the road? Because I think that that's what's going to dictate for us more than anything else on how much we pay in taxes on this balance as we have. We talk also in chapter 2 about widow's penalties, right? Many people probably already know this, but eventually down the road, I got one son, he's 14 years old. When dad's gone and mom's gone, in whatever order that happens, probably me first because I'm the guy, right? It's a good thing I got a thick neck because I'd be gone a long time ago sometime. But anyways. That's a terrible joke. I got to quit doing that. My son will be paying taxes on that. When I pass on, my wife will probably be paying single tax rates, widow filing rates. Has anybody experienced that? Where there's a married filing joint and we drop down to about half as much income at the same tax bracket as when you're married. So I think we need to start foreseeing what that's going to look like for us so that we can start planning accordingly. That's what astute people do, right? We talk about tax secrets. It's really about forecasting what that might look for us. If you're in a 20 or 12% bracket while you're married filing joint, we see a lot of families push up into a 24% bracket. We're talking federal numbers here. When there's a passing of a spouse, that's a 100% increase on taxes for each dollar pulling out at that level. Let's get as much as we can paid off at 12%, 22%. Okay. When my son inherits it, he could very well be in a position where he's now under today's tax code, you got to take it out over 10 years. Think about leaving. I've seen your balance sheets, right? Some of us, we're all in different situations, but if we have an amount of money that's going to be going to the kiddos someday, and they're going to be paying higher brackets right at the wrong time. Maybe kids will be going to college in there, so whatever that is, I'm starting to look at. Some of you say, hey, it's free money. It's okay. That's okay, right? But it's about looking at how that works and also understanding that IRMA, which is income related to Medicare adjustment amounts, the amount of premiums, what we pay for our health insurance is dictated by the amount of income we make. Some of you have seen this. We get above a married filing joint about $170-some thousand of income because I'm moving money from an IRA to a Roth. I get to pay extra Medicare premiums. It's the same exact insurance as everybody else. They talk about for years, we're going to means test Social Security. I think it's less likely. I think that those that have got higher incomes are going to get to experience a net number less, but I don't think they're ever going to take away Social Security from everybody. But they're going to continue to tack on some of these hidden taxes like Medicare premiums, losses of deductions, things like that, right? We saw that during COVID. Neighbors might have seen a check, or maybe some of us did, but stimulus checks, and some of us didn't see it because of where we were at income-wise. Right? It always drives me nuts. Somebody comes in, sometimes they're like 64, and they're like, I want to make sure I can qualify for, I gotta be careful, I'm not sure if anybody's done this here, but I want to qualify for Minnesota. They give you deductions if you're below certain income levels, and sometimes we're just painting ourselves in a corner because sooner or later all this money has to be taxed. Now the book isn't just around our IRAs. I just spent a little time on Social Security. If you haven't read my book, it needs to be updated with some new tax law changes, but make sure you grab one on the way out the door. But everybody realize that Social Security by itself is 100% tax-free? The way it's set up right now, there is not a person in the room here that if that's the only income you needed to live on, you would never have to file another tax return. Right? Not you, maybe, but why not, Ed? It's because of these other sources of income, right?
Correct. Is that both federal and state?
Both. I'm going to say federal for sure, and I'm going to say I think in most cases, no, it would be federal and state, because the way it works is this. I'm going to use some ballparky numbers, okay? You know what? The new tax deductions for a single standard deduction is a little bit better than $12,000. And for a married filing joint, it's a little bit better than $24,000, okay? The calculation, what's called provisional income, did I take this out? I did. The IRS has us calculate what's called a provisional income. What's included in the provisional income? Number one, it's half the Social Security benefits. So for a married couple, we've seen families close to $80,000 a year in Social Security income. A little bit close to 7,000. I don't know if we've had anybody above 7,000, but that gets us close. I'm just taking the extreme here, right? So between a husband and a wife, they're making about $70,000 a year, 80. Only half of that has to go into the calculation provisional income. So they got a $40,000 number there, okay? If $40,000 of my Social Security is taxed, I take off $25,000 for a standard deduction, right? I'm doing something a little bit wrong. Oh, of the $40,000, it basically, I'm trying to stay away from the numbers. I jumped right into it. I'll do a better job in the book outlining this. The amount of Social Security that gets taxed for a married filing joint couple is they get taxed on half, 50% of the Social Security between $25,000 and $32,000. Okay, so that's a $12,000 number that says $6,000. If I got $40,000 of Social Security income that's taxable, $6,000 fits in that range, and then 85% of everything above $32,000 is taxable. So that another 8 in that case. Let's just call it 6. I take that 6 plus the other 6. I got $12,000 of total taxable income on my Social Security, and I get to write off 24. So Social Security by itself, and there's not a person in the room that ever paid tax on Social Security income if you could live on that alone.
But Minnesota is considering, because of the amount of extra money as sitting around, that Social Security would not be state tax. So that's not happening.
Who in Minnesota is considering that? Not the governor.
Not the governor, he killed that.
Yeah, you tried. Yeah.
For years, I used to sit there and say Minnesota is one of the few states that didn't tax like military pensions, and now they finally did. But it took them forever to do. I don't know how quick let's hope it happens. I think it'd be a great deal. What we want to keep in mind is as we start projecting out our taxes, if Social Security could be tax-free, dividends, interest, capital gains, pensions, required distributions all come into play and how much more we get taxed on it. But even with that said, even at that higher level, $80,000 a year of income, 15% of that money is completely tax-free. So choosing whether you take money from an IRA today or optimizing Social Security and getting more out of Social Security because of the tax efficiencies of it and the compounding, the COLAs and such that come into it, oftentimes waiting makes more sense, not for everybody. So we can sit down with you and make sure we do that for you individually. But I spent some time in chapter 3 talking about Social Security and why we want to think about optimizing it.
Joe, there was a question online specifically about the state of Minnesota versus other states and taxing of Social Security, just because we had some questions in the audience and sometimes that doesn't be heard by our online audience. Would you mind repeating that a little bit as far as what state, how applicable states are to tax of Social Security?
I'm going to go back that if I don't have to pay any federal tax, then I won't have to pay Minnesota tax on the income either, okay? So if you can keep the federal tax bracket to zero, you won't pay tax in Minnesota or New York. I'm trying to pick another high tax state. I don't remember what the numbers are now. About 2/3 of the states do not tax Social Security now.
Only 12 states do.
Okay, so
That means
it's about a quarter. Yes, so 75.
less than a quarter.
Yeah, tax Social Security. The rest of them do not, right, Mike?
Yeah.
So Minnesota is the exception as one of 12 that tax Social Security.
Probably like Massachusetts.
I would guess that if you went, on the East Coast and West Coast up, then you could probably figure out which states are more likely going to tax Social Security. Maybe our neighbors, a couple states over in Chicagoland do, but I mean that's kind of the way it works. So, and I don't remember, but it's an easy Google. If you want to look it up, it's right there.
What's strange about the states that do and don't is almost evenly divided between Democrat and Republican.
I mean, red or blue, right? On which ones do or don't.
I mean, you wouldn't expect that. You would think, well, the conservative Republican states are all going to be low tax, but some of them are not.
Maybe we can have somebody Google that. We'll Google it, and I can show you that it's fairly straightforward there and which ones they are. And if they want to follow up with me afterwards, I'm happy to answer that individually. Good enough. Talk about planning before the crisis. I mean, a lot of the book is really about that, right? It's about, we know that there's a storm coming, whether we call it a hurricane, whether we call it the volcano, or whether we just say there's a beast living amongst us. We know that families that we all do better when we can plan before a crisis than when we're in a crisis. Why does SEAL teams practice so that when it gets to a situation that's high stress, they know what to do? We need to be doing the same thing with our retirement planning. Think it through, what's going to happen if this happens, or how do we go through it? It's about contingency planning, and it's what I hope everybody in the room here that works with us has received through our planning process. If not, I want you to schedule some time and let's make sure that we are revisiting on that, because we want to make sure that if we know there's something that's pretty certain that's going to happen, higher taxes, then let's plan accordingly, right? So I talk a little bit about charitable gifting. For the most part, if you're under 72 and not taking required distributions, there's some smart, astute ways to maybe gift a little bit smarter than what many of us do. Many of us are writing checks to the church every month, but yet when it comes down to the deductions at the end of the year, we're not able to take that. There's ways that we can avoid paying capital gains on things, or maybe grouping up several years into one. It's called a donor advised fund, where I can give several years in one method. Lower cost is just writing an extra check in December. So we talk about some of the things to do around charitable gifting if you're doing that. After age 72, for the most part, we find that doing a qualified charitable distribution, if you have IRAs, taking money from an IRA, writing it directly to the church or the Salvation Army or the charity of your choice, avoids it. It satisfies the required distribution and becomes a non-taxable transaction as it goes to the charities. So we spent a little bit of time talking about some of that too. Questions on anything? Any more questions? Yeah, Bob.
You mentioned the tax rates are going to run out December 31st, 2024.
As they currently sit, yes.
Okay, then you mentioned.
Wait, 2025. Let me take it back. 2025.
3.5 years, I'm calculating now.
No, it's 25. It's January 1st, 2026, but I've been told I should say December 31st because that's the official day. It's 2026 is the year that we will go under the old tax code. If nothing else changes, my guess is there's going to be some hybrid, but we won't know what that is until sometime in 2025 or maybe a few months into 2026 even. Good question, though.
That does answer one of our online viewers' question as well, which was just clarity on when is the tax change occurring.
December 31st, 2025, which will be filed in April or October of 2026. But the last year will be under this current tax code. Unless things change, if Congress does nothing, we will revert to a new tax code on January 1st, or the old tax code on January 1st of 2026.
Then they'll decide they need to add more.
Well, I think that there's always going to be things around, I could see them changing taxes around Social Security. That'd be one of the easiest things they could do. Start, having some families paying 100% tax on Social Security, raising another level. Yes, Mike.
So, when we go back to, we'll call it the pre-2017 tax code, will that mean that the bigger standard deduction goes away and we'll get to claim personal exemptions again?
As it sits today, yes. Now, that is one of those, I think bipartisan, there would be a lot of support to keeping a higher standard deduction. There would be some things that there's, a lot of higher taxed states where we're limited to $10,000 a year that we can write off for state and local tax, what they call SALT. There'd be a lot of push to try to raise that threshold so that folks that are in higher income or that are in higher tax states can take better advantage of some of the deductions. But a higher deduction than where we were pre 2018 is probably, I would anticipate we will see that. I can't, who knows, whatever they do, they're going to do. But
They're always changing.
right. But I think that is actually one of those changes I think we are going to see. I think we're going to see a change in the, the Secure Act 2.0 that there's a little bit in the news here in the last 48 hours over the weekend on it. If you look at the Wall Street Journal or Forbes or something, you'll see some things. I think that'll probably pass eventually, pushing the required distribution to age 75. But it's going to be a gradual increase, and I think many of us.
Nice for these young kids like her.
Yeah, the young guys, the young kids are going to. If you guys haven't met Ryan Keeproth, he's our newest advisor here. But this guy, you'll probably get to wait forever to, But I also think there might be some changes around Medicare and things like that too. There's been talk on it going two directions. One being a little bit sooner that you'd be eligible, and one saying that a full retirement age is 67. Why are we still basing Medicare on 65? But who knows what they're going to do there. Lots of changes. One thing we do know is, one thing I can know with certainty is that I have no idea what it's going to look like in 2026. You can speculate. What's
Joe,
more important is that you can look back and say I did the right things, or if I did make a decision and it didn't work out quite in my favor, at least I'm okay living with it the way it was, knowing that I was trying to avoid something else. So that's a lot of what we talk about too. Yeah.
Specific to your book, do you have sensitivity to that timing in the book, like actions that you should take now? Or otherwise, the question is, would you be updating your book once these possible tax changes will occur?
The answer is that the book took me a lot more work than I thought it was going to, and I'm not sure I'm going to be writing any books right now. It's kind of like, ask the guy that just won the Super Bowl what he's going to do. He's probably not, many of them go to the gym, I guess, the next day, but a lot of them aren't looking at training already starting up. I want to put it behind me for a little bit, but I don't talk about, I talk a lot about how we need to be proactive in some steps that they can do. So there are some actionable steps in the book, and we'll make sure that they get that. A lot of it has to do with making sure that we're looking forward and doing our tax planning proactively and not necessarily reactively and just waiting for this storm to happen. So that's really what most of it's about.
Thank you.
Yeah. All right, where do you get the book? Well, you come out to a session like this, everybody gets a copy of the book. So if you know friends or family that would like a copy of the book, ask them to stop on by. We'll be happy to give them a copy of the book. It's available on Amazon. We ask your local bookstore, maybe if enough of you go out and ask where my book is, they'll I don't think I'm going to make the New York Times bestseller. It's our last Social Security book did actually hit an Amazon bestseller, so that maybe they'll do something like that. But a lot of it has to do with how fast the books get ordered and the period of time. But I didn't write the book necessarily to try to get a bunch of royalties. I wrote the book to try to help as many families as I could. So any other questions? Otherwise, we're going to talk about what's coming up. July 4th, offices is closed, so there's not going to be any market huddles that week. We're going to have 2 other market huddles. January 11th, we're going to bring in Ryan Dillon again to talk a little bit about income planning, some steps to think about and protecting from longevity. Although personally, I think one of the biggest hedges we have against longevity is to try to reduce the amount of tax we pay, because we see families that can save tens of thousands, hundreds of thousands of dollars in lifetime taxes by doing some things proactively. Makes your money last a little longer, keeps it in your pocket where it belongs. And then surviving and thriving during recessions. Ryan Keeproff's going to be doing that one, so that'll be in a couple weeks. Those are both going to be online, the market huddles. Those of you that have watched us a little bit, the third or fourth Monday of every month we do the
Fourth.
face-to-face. Fourth Monday of every month we do a face-to-face, and the other ones we do a online. So any questions, concerns, thoughts? All right. Well, hope everybody enjoyed. If you're watching online, or if you haven't had a chance to visit with us, if you want to look at how the book impacts you more personally, let's schedule a review with one of the retirement advisors here. Yeah.
Quick question, maybe, I don't know if you can touch on this, but I self-direct my Roth IRA into real estate.
Okay.
I can't get an answer on UBIT.
Business in something
Unrelated
tax.
business income.
Unrelated business. So what you want to be careful of more so with the real estate is the unauthorized transactions.
Yeah, that's covered.
Okay. And I also would applaud you for just putting it in the Roth versus a traditional IRA. So the problem with using real estate and investing in real estate or any of these other, I don't want to say alternative investments. Keep in mind at 72, you got to calculate what the required distribution is. If I got a property I say is worth $500,000 and the IRS comes in and says it's $600,000 and you didn't take out the right amount, they can come back and say that you didn't take enough, and then there could be 50% penalties on the distributions. On the other side of this, if you go in and as much as change a light bulb, they can say that that was an unauthorized activity. If it's in an IRA and you're above 59 and a half, they could say the IRA has to be completely liquidated and pay tax on it. If you're below 59 and a half, you have a 10% penalty on top. If it's in a Roth, at least you avoid the taxation if that were to happen. I usually see the UBIT on things like limited partnerships and such that are owned by the account, but I can get you a really good answer. I've been a member of Ed Slott's organization. He's the number one.
Specifically, what I'm trying to figure out is that we paid, so my understanding with UBIT is that it doesn't apply if the asset is free and clear for 12 months or longer.
Okay.
So I'm trying to get an answer that my CPA looked at me like deer in the headlights when I asked him, but he's like, what is UBIT? I'm like, yeah, I'm going with the wrong guy.
Let me, in fact, I can try to, if I can't do it, I'll get somebody on the team to make a phone call with you to Ed Slott's group. And before you even leave today, let me see if I can get you a little bit better answer to that, or at least get something written,
Yeah.
some code.
Well,
Actually,
even a plan to, because I'm, 58, so I've got a few years left before
Yeah.
I need to tap that stuff.
I will.
So invest before I retire, or do I keep it? I guess that's kind of what I'm looking for.
I am, my bias is I'm not a big fan of the real estate and IRAs. So we don't do a lot of that here. I'm not recommending it. And if we did, we would probably be pushing more like a traded REIT or something like that. But let me get you a better answer than that. And I'll go right to the best source I got, which is Ed Slott's group. So anybody else? Well, thanks all for coming.
Thank you, Joe.
All right.
Thank you.
It's a
If anybody does have anybody, I would love if you got something you think would benefit from the book after you go through it, give us a call. I'm happy to make sure we hand you some that you can maybe share with friends or whatever. So,
All right.
all right. Well,
Very
we'll
good.
see you. You been to Portugal much?
20 years.
Oh, no, I asked, me and Ed were talking at a game, and me and my family going to 2 weeks to Portugal, and I'm like, okay, where do we go? And he gave me a lot of great ideas. He owns a rental out there.